What is unique about Heritage is that the core group of partners and employees that work for our firm are people that have known each other for a very long time. We are a close group of friends and family members that have been working together since 1993. We share a very strong set of beliefs about how assets should be managed and about how the relationship between an advisor and an advisor's clients should work. The financial aspects of our investment process are very well steeped in historical financial research. They're time-tested and they work very well. There are three main ideas that we focus on. Capitalism works. Capital markets have generated tremendous amounts of wealth for investors over time, and we have every reason to believe that that will continue to be the case. Markets work in unpredictable ways. So yes, capitalism will make us money over time, but the short-term moves of the capital markets are completely unpredictable, and attempting to speculate on the short-term moves of the market really amounts to nothing more than gambling. And those types of speculative ventures tend to be harmful to an investor's long-term investment returns. We want to stress the idea that risk and return are related. What this means essentially is that, yes, equity markets do offer a higher expected rate of return over time. However, if you want to enjoy those higher expected returns, you have to take some amount of risk, and properly managing that risk is of the utmost importance, and it's central to our investment process. The financial aspects of our investment philosophy are time-tested, and they've worked very well for us, but we find that the psychological aspects are much more important because the way people feel about their money really tends to drive the decisions that they make, both in good times and in bad times when it comes to investing. So what is really important about the psychological aspects of investing is that an individual cannot be completely objective about their own money, and this is where the importance of an advisor comes in. We can do one thing for you that you cannot do for yourself, and that is we can be entirely objective and unemotional about your money. Anyone who had an investment account during either the tech boom back in the late 90s into the early part of the 2000s, or during the global financial crisis in 2008 can understand what I mean when I say that emotions can have a significant impact on someone's investment behavior. People tend to want to buy stocks in good times after stocks have run up without really asking what the valuations are, if the underlying companies are really worth anything. And even more importantly, people tend to want to sell stocks after a period of decline. The financial part of what we do is time-tested, it's been very successful, and it is important to get that part right. But the most important thing that we do for our clients is to help them manage their own psychology and their emotions during the inevitable ups and downs of an investing lifetime. And this allows us to have a significant and positive impact on their lives.